Welcome to another of our weekly investment manager videos, and many thanks once again for tuning in. The UK market flattered to deceive during the most part of 2020, whilst other more growth orientated markets such as the US raced away and took all of the headlines. However, since the rollout of the COVID vaccines, we are witnessing somewhat of a paradigm shift, with the FTSE 100 up over 8% year to date. So is this performance sustainable? And what is the outlook for UK equities? Well, who better to ask than one of the founding members of Riven Mercantile, head of value and recovery, and manager of the UK Recovery Fund, amongst others, Hugh Sergeant. But before we get into the content, if you are enjoying this, it would be wonderful if you could subscribe to the channel. There's a button below, somewhere along there. You'll see it's a big red button that says subscribe. This really does assist us in delivering our financial planning and investment manager content to a wider audience, and you'll be genuinely helping the channel. So onto the content. Hugh, many thanks for your time today. Kicking off, there's been a clear rotation into value stocks over the last 6 months. How sustainable is it?
Andrew, I think we're just at the beginning of a strong period of performance for value stocks after over 10 lean years since the global financial crisis. The world is now arguably moving into a more inflationary phase, during which interest rate expectations and government bond yields trend upwards. This will be an environment that is more supportive of value equities and inflation hedges than the deflationary period since the GFC. This change of direction in bond yields will ensure that this value cycle has legs. Meanwhile, actually, if you think look a little bit shorter term, say the next two years, value and recovery will be well supported by strong business fundamentals. So we're in the sweet spot of the cycle for these types of stocks, as they're the most geared to both economic recovery and the bottoming out of interest rates. With a big value gap still in place. By that I mean spread of valuations between cheap and expensive stocks, and then robust fundamentals. I think the immediate outlook, the next 2 years for value is very robust, and I don't think the return to value will be a 6-month wonder.
It does sound very, very positive indeed. Now, looking at how investors can actually access this, is it an option simply to buy the index where the constituent parts are in the majority cyclical based, or do you believe that there's genuine advantage in going for an active value manager such as yourself?
I mean, that's another good question, Andrew. I mean, I think most investors have a mix of passive and active strategies these days. Perhaps passive to keep costs down, and then active to provide the option of significantly beating the benchmark return. I mean, if you can identify active managers that have an investment approach that can do better than the index, then you can create a lot more wealth. And I know clearly that's one of your areas of focus and added value. I mean, the power of compounding is very exciting. So just to give an example, £100,000 invested for 20 years at a 10% per annum return gives you about 670 grand. The same amount invested at 14% per annum return grows to almost twice that. So if you can find managers that can add alpha, can outperform the benchmark, then you will create a lot more wealth. And I hope we're in that camp of managers that can genuinely do that. If you look at our UK recovery strategy, since its inception, we're annualizing at 5 to 6% per annum ahead of the benchmark, and that's after fees. So I think we're in that camp of active managers that can, genuinely create additional wealth over and above the benchmark. And obviously today we're giving you that extra exposure to the value and recovery part of the market, which has been pretty depressed, and hopefully is going to come through over the next few years with strong returns.
Yeah, and may I just add from my perspective as someone who reviews the market and select funds, there's been a lot of managers who have kind of given up the ghost over the last few years in terms of value as an investment style, and so do your work very very carefully and make sure that you are selecting active fund managers. Then you are acting, selecting true active value managers if that is the approach that you wish to take. Um, Moving on to your fund and some of the stocks that you've got involved, are there any particular names that you'd bring to our attention that you feel will deliver particular upside, stocks that you may be really excited about?
Yeah, I mean, we've got a relatively diversified portfolio, but let me just take you through, one or two stocks that were particularly exciting, and I'll just describe them in the context of how they fit into the portfolio. I mean, the first area would be, traditional value part of the portfolio, so deeper value stocks that are backed by tangible assets, and here would include companies that will benefit from higher interest rates. So as already mentioned, that we think interest rates are, trending gently upwards,
Mm-hmm.
and they'll provide, strong hedges to that upward movement in interest rates. I mean, in this area would include banks such as Lloyd's. So we think Lloyd's is still a very strong banking franchise, has over 20% market share in most of its lending categories. And we're at the point in the cycle where their profitability is depressed, but starting to recover significantly. They've also got a lot of excess capital in the balance sheet, which they'll be able to return to shareholders over the next few years. And we actually think their margins, so their profitability, will be trending upwards. And at this meanwhile, with the fundamentals improving, it's still on a very lowly valuation, so it trades on about 0.7 of tangible book value, so a discount to that part of the balance sheet. So that would be one of the first ideas. The second would be a classic recovery stock. So recovery stocks for us are companies, good franchises, where the profits are temporarily depressed, where we're confident that profits will recover. And a great example at the moment would be Whitbread.
Mm-hmm.
Used to be a brewing company, is now very much a hotels focused business, and owns the very strong budget hotel brand Premier Inn. Has a classic recovery profile. I mean, as the need for social distancing abates, the UK economy recovers
Yeah.
robustly, so will the demand for their hotel rooms increase from currently very depressed levels. The other point about Whitbread is that it went into this difficult period with a very strong balance sheet, so it's been in a position to invest, and it's also got a fast expanding budget operation in Germany, and that will provide attractive leg of growth. So it's recovery and growth.
Mm-hmm.
And then the last stock I'd mention is a UK domestic recovery stock. We're looking at strong franchises, but which may have been temporarily impacted by COVID, but actually going to come out of this difficult period stronger. And in that, we'd put Restaurant Group, which
Mm-hmm.
one of its key high street franchises is Wagamama's, which would be well known to all of us. Attractive high street restaurant chain with significant medium to long term growth from here. Obviously, restaurants life has been tough for them over the last year.
Mm-hmm.
But the survivors, of which Restaurant Group is very much one of those, actually going to be in a stronger position, because I think about 15% of sadly of restaurants have had to close
Yeah.
down over the last year.
Mm-hmm.
So the ones that have survived are going to be stronger, especially the ones that have growth franchises, such as the Wagamama franchise. So just a few
Mm.
examples of how we're thinking, and individual stocks that we like at the moment.
Yeah, thanks for that, Hugh. I think for me, the main takeaway from what you've been saying today is, yes, we're moving into a new. I've used the term epoch in previous presentations I've made to clients with rising bond yields, but the reopening of the society is providing huge opportunities. And I think everyone watching this today will understand that the number of companies who haven't been able to trade during the last 12 months, they are now having the opportunity to, and surely that will become profitable. So the opportunities in front of us are potentially huge, and it's important to have the right manager at the helm to exploit these and look for the opportunities. So once again, Hugh, many thanks for your time. It's been an absolute pleasure speaking to you, not only today but over the last few days where we've had meetings. You take care, and I'm sure we'll catch up soon.
Thank you very much.